We've seen a bit more of a return to normality, and I suppose that's taken a little bit of uncertainty out of markets, and markets were looking for some of the catalysts around getting some clarification around some of the tax policies and government policies, but also the Federal Reserve policy as well. So they've now made a move. That's the first move since late last year where they've reduced rates. And there's enough evidence that the chair and the committee made the decision to look to reduce rates in the face of what they see as probably stabilising inflation and a jobs market or an economy that needs a little bit of stimulus coming into it. If we look at markets for the period and a bit of an extended period beyond just the month, Australia actually lagged the rest of the world. So it was a bit of a slower month, but you are, as we mentioned last time, starting to see quite a divergence between different elements of the market. So the large cap underperformed. It was a very small negative performance for the month. And for the year, it's sort of mid to high single digits. Quite different to the small caps. Now, the small caps, we've been talking about for a while now, it's one that from an earnings outlook and a valuation perspective looked appealing. And the market's starting to see that opportunity and deploying more confidently into those sorts of investments. So we've had rates cut here, which is a bit of a positive sign for those sorts of businesses. Many of those businesses are impacted by consumer spending patterns, and I suppose with rates coming down, consumers have got a little bit more money to spend, and therefore you're seeing a bit of a rotation and an uplift in some of those smaller cap names domestically. Looking at markets, China has performed relatively well in this last sort of 6 or 12 months. A bit more confidence, I suppose, on the outlook there, that it had been quite a challenging outlook economically. There's a bit of stimulus still probably expected by markets, and a bit more confidence that that may play through into markets. That's obviously had a bit of a positive impact domestically here, with some of the commodity prices increasing, and then therefore playing through into some of the commodity businesses, with resources being one of the stronger sectors in the last month, and also this year as well. So the US has been still dominated by the mega cap businesses, and that's rotating a little bit as well. So the winners in that are probably more aligned to the AI trend that we've all been reading about, hearing about, talking about, and probably using a little bit of. So that's one that's broadening out a little bit, but it's still in quite focused areas compared with some of the other economies around the world. And small caps in the US is still lagging. So the earnings outlooks, the growth profile that's in the US is still more heavily in the top end of the businesses, the larger cap businesses, where tech's still looking at 20 to 25, if not 30% earnings growth year on year for some of those businesses. And they're enormous numbers if you think about growing a large business 30% for the next couple of years. It's significant. So fixed interest markets have been relatively stable, and if you look at the volatility in that part of the market, it has stabilised to a reasonable amount compared with where we were earlier in the year. And volatility generally has started to stabilise a little bit, with, I suppose, a bit more conviction that rates will start to reduce, and there's a bit more confidence that there will be a bit more stimulus put into markets. But effectively, interest rates from a 10-year perspective have been around that sort of 4.1, 4.2, 4.3% level for a period of time now, both overseas in the US and also here. The short end, so obviously looking at cash, with cash rates coming down, we've had a pause here with another meeting for the RBA not expected until early next month in November. But the Fed's made their first move, as I said, first move since end of last year, with another meeting later this month in October to reassess what the impact of that has been, and then obviously make a decision as to what they do next. Diversification is really key. It is really hard to pick these short-term trends, and they can rotate quite quickly. So where something may be out of favour for a period of time, a month, a quarter, a year, it can quickly rotate. And so we're having this conversation a year ago, we were probably talking about small caps being unloved and out of favour and lagging other parts of the market. Now you're seeing their returns for this year almost doubling what has come through from the large cap names in Australia. And you can see those trends all around the world in different types of sectors, and it's quite hard to predict those short term. You've got to try and be invested for what you're trying to achieve. So long term is where most of our clients are looking to in terms of what their future is and where they're investing. So trying to find managers that have got that focus, trying to find markets that will generate reasonable earnings growth over a period of time as well. So there's no one way that you can perfectly play different investment markets, which is why we continue to espouse diversification.